More on that. The 2-year-old sovereign debt problem seems to be worsening, not getting any better. What's the worst case scenario facing the global economy? Joining me tonight on Your World at 10, Peter Westaway. Now, Dr. Westaway is NOMURA'S chief European economist. He's worked previously with the Bank of England as well as the British Treasury. Dr. Westaway, thank you very much for your time. We've had such a difficult weekend and equity is nervous across the world today on account of Europe's sovereign debt problem. How bad is the situation in Greece looking? Will it be just a reprofiling, as most politicians seem to be pushing for, or is it more likely going to be a restructuring?
I think the most likely outcome is that there will be some mild reprofiling, in the sense that certain investors, probably the Greek banks, will be asked to roll over their loans when they become due. So that's not a formal reprofiling, but it does effectively lessen the need for the Greek government to go to the market or go to the EU and the IMF for extra funds. The reason why I think they're perhaps going to shy away even from this reprofiling or maturity extension is that the ECB have made it very clear that they're not happy with that solution. They've threatened to refuse to accept collateral of any banks that do that. So I think there's a real game of hardball going on between the ECB and the EU politicians. But I think new money is going to be forthcoming for Greece. I think at the moment there's a debate going on about whether or not they've done enough in terms of fiscal consolidation and structural reform to even give them the next tranche of their original package of money. And the IMF are making saber-rattling noises as to whether they're even going to give them that. But I think in the end they will, and I think probably by June a new package of measures is going to need to be done by Greece, which will then give them access to even more money. I mean, the short-term political problem is that Greece has got to get agreement amongst its sort of governing party and perhaps with the opposition as well, in order to make a credible commitment to these policy changes over the next few years.
You seem convinced, Dr. Westaway, that we aren't faced with the inevitable occurrence of a restructuring, while several economists in fact do believe that a reprofiling will in fact push a restructuring only further down the road. We're not going to be able to escape one.
I mean, there's two things I'd say on that. I mean, first of all, I think the argument that all we're doing is sort of buying time for Greece is not really a valid one, because in a way time is exactly what Greece needs to implement these really difficult fiscal consolidation measures, these tough structural reforms. They don't come quickly and they don't necessarily deliver straight away. As far as a restructuring is concerned, and really here we're talking about some sort of haircut on the debt, I think the problem is that people are over-exaggerating the potential benefits of taking a haircut. There's no sort of panacea or easy option for Greece. You've got to remember that by the end of next year, over half of the debt that Greece holds is going to be owned by, or that they've issued, is going to be held by the official sector, by the IMF, by the EU and the ECB, and it's going to be virtually impossible to haircut that debt. I mean, the IMF don't do haircuts, the EU aren't going to want to haircut their debt, because that would be tantamount to a transfer from the EU to Greece, and they've always said they won't do that. So that then means you've basically only got the remaining private sector holders left, and I mean, even there it's tricky, because the Greek banks you can't really haircut, because if you cause them problems, you've got to just pump money in somewhere else, and so the Greek government will still be on the hook. And I think probably the most serious reason why people over-exaggerate the benefits is that, I mean, without a haircut, Greece needs to turn their fiscal balance from being a minus 5% primary deficit to a plus 5% primary surplus. If they haircutted by the amounts I'm saying, that would turn into going from minus 5 to something like plus 3.5. So it's a huge fiscal effort in either case. It's not a get out of jail free card for Greece. They've still got a really tough fiscal challenge up ahead of them, whatever happens.
They're going to face internal political opposition on account of fresh austerity measures, as you pointed out, external political opposition if private lenders don't take some form of a haircut, and in fact if Greece does get a reprofiling of sorts or easier bailout terms, aren't Ireland and Portugal going to ask for the same terms? Now, where does this end?
Well, I just said that I thought there were risks associated with a haircut as well, and that's exactly my point. Haircuts run the risk of contagion. Even reprofiling runs that risk of contagion. As you say, the Irish, the Portuguese, perhaps even the Spanish, and that's where it starts to get slightly more scary. They then get sucked into this issue, and the very weak price action we've been seeing in markets over the last few days and weeks would potentially get even worse. So again, I think that's one of the reasons why policymakers are hesitating. They're slightly reluctant to open up this Pandora's box for fear of what may come out.
We've had worse news over the weekend. The political issues in Spain with regards to the ruling party losing the regional elections. You've got the S&P downgrade on outlook for Italy. What is the magnitude, Dr. Westaway, that of this sovereign debt crisis? I mean, last year when this problem began to unfold, we never imagined that we would be including in that list Italy as well.
Well, let's not get ahead of ourselves here. I mean, those sovereign spreads haven't yet blown out to a level where there's a real crisis in those countries, and they're not at the point of needing assistance. But of course, that's the risk, and I think the magnitude of the problem, if certainly Spain, but I mean, if Italy got dragged in, then that would be an absolute disaster for Europe, and the sorts of financing solutions we've seen so far would be stretched to breaking point. I mean, I think in that situation, if we wanted to keep the euro area together, I think this process of trying to get the rich countries to provide financing might not work for much longer. You'd have to probably go down the Eurobond route, something like that, where you provided sort of jointly guaranteed financing. But again, we're not there yet. Of course, the municipal elections in Spain were disastrous for the Zapatero government, which was already a minority government. But I mean, that doesn't necessarily stop them being able to function from now up until the general election next year. So there are still reforms that they need to take place. They've made some good progress this year. Hopefully they'll carry on with that, although it's more risky now. Italy, slightly different situation. We've had a downgrade there from the S&P, but I think Fitch have come out this morning and said no, they're still maintaining their rating. They don't see that negative outlook that S&P did. So, I mean, I think Italy are in a very different position. They have the disadvantage that they've just got a very high stock of debt. Their levels of deficit that they're needing to correct are much smaller. But inherently, when you've got the debt that size, any loss of confidence which starts to put your interest rates up starts to become a self-fulfilling crisis, and that's when it becomes dangerous. I think what's happened in the past to the weaker countries, although in the end it hasn't been successful, but what could happen here in Italy and in Spain is that it brings forward the necessary policy measures to try and calm markets. Sort of beneficial contagion, if you like. It benefits. It forces policymakers into doing the right thing. In the end, whether that's going to be enough to keep Spain away from the drop, if you like, is a tricky question. At the moment, our central view is that they're going to be okay, but I wouldn't want to put a 100% probability on that at all. There's a big risk on that now.
Well, that's a telling comment. Quick last question, and that is, we've seen the impact all of this has been having on equity markets today, over the course of last week, and over the course of the last several months. The impact it's been having on the euro, by virtue of which the dollar has been strengthening, and that in how it's playing out on commodities. What do you make of the effect these sovereign debt concerns will have in the medium term on the euro, on the dollar, on commodities as well as equities, especially in Europe as well as the US?
Yes, I mean, there's been a number of different phases in markets for this sovereign debt crisis. I mean, if you go back to a year ago when it first broke, when Greece first got their big 110 billion euro package, at that time, whenever sovereign spreads in Greece blew out, the euro fell. There was a one-for-one movement. The euro was trading like the drachma, people used to say. And then, really the last 2 or 3 months until quite recently, there was a decoupling, and it looked as if policymakers had successfully ring-fenced the weak periphery countries, so that, for example, when Portugal were required to take funding from the EU and the IMF, the euro hardly budged. The last couple of weeks, it started to get a little bit more as if the risk about the system, the systemic risk, which would obviously kick in if Spain and then Italy got involved, has started to undermine the euro again. And so we're back in that more risk-averse phase, and the euro's looking a little bit more fragile. And then on top of that, not only that in equity markets, but we're just starting to see this morning some of the activity data softened a little bit more than people were expecting, or the forward-looking PMIs, the forward-looking data. And so I think people are starting to say increased fragility in the periphery, ECB tightening interest rates, a weakening global picture, all of these things could all conspire to make this sovereign crisis get worse. Again, that's not our central expectation, but those are the risks that at the moment are starting to look as if they're a little bit more substantial than maybe they did a few weeks ago.